Today, Wall Street flashed a signal that may be easy to ignore at first glance. But historically, this type of movement appears right before the broader market experiences a meaningful shift. This wasn't a headline event. It wasn't a last-minute sell-off. It wasn't even anything dramatic on the charts. Instead, it came from the institutional side where the smartest money in the world quietly repositioned itself. Let's start with the most important detail. Today, several large hedge funds increased their exposure to defensive sectors while trimming positions in growth and beta stocks. This rotation wasn't large enough to trigger alarms on retail screens, but it was strong enough to show up in block trade data. When institutions rotate like this, it usually means they expect a market move in the near term. At the same time, the volatility index began climbing slowly but consistently. Markets don't fear slow volatility rises unless they are paired with subtle drops in market breadth. And that's exactly what happened today. While the major indices looked stable, fewer stocks participated in the upward movement. When breadth weakens ahead of the volatility curve, it sends one of the clearest early warning signals in the market. Another important clue came from bond yields. A sudden intraday shift in yields pressured specific parts of the equity market, especially companies with valuations tied closely to future earnings expectations. Tech and consumer discretionary stocks reacted first, showing hesitations that align with big money positioning changes. These movements rarely happen randomly. Meanwhile, options flow revealed something even more interesting. Instead of retail-driven bets, today's options activity was dominated by large, slow-moving spreads placed by institutions. These spreads weren't directional, they were protective. That's a sign of preparation, not speculation. It means the next move might not depend on news. It may already be forming under the surface. Another signal came from liquidity. Market liquidity tightened during several key trading windows today. This behavior normally occurs ahead of macro events, earnings clusters, or unexpected announcements. When liquidity thins, even small orders can move prices more sharply. Markets don't like thinner liquidity. It increases short-term volatility and widens the reaction range. Let's also talk about sector divergence. Energy and financials strengthened while tech and consumer stocks softened. When cyclical sectors rise while growth sectors hesitate, it's often a sign that investors are positioning for potential slowing in certain parts of the economy. This doesn't guarantee a reversal, but it does warn of a possible shift in leadership. But the most important clue appeared at the end of the trading session. Institutional order flow suddenly flipped from mixed to decisively defensive. We saw an uptick in put buying, an increase in hedging activity, and clear trimming of positions in the stocks that have led the market for the past several weeks. These actions are usually the final steps institutions take before volatility picks up. So what does all this mean? It means the market is preparing for a move. The direction isn't confirmed yet, but the conditions are developing for either a sharp upside breakout or a fast downside correction. What matters is that the environment is shifting, and traders who recognize these signals early tend to stay ahead of the major move. If you want to keep up with these hidden signals, subscribe to Wall Street Market Brief each day. We break down the real movements behind the headlines so you can react faster, trade smarter, and stay informed in a market that changes quickly.